Hey, what's up guys, Michael here. In today's video we will be talking about the introduction to technical analysis. So we will talk about today about the resistance and support levels, how you should use them and how you should mark them. And the second thing, we will talk about the Fibonacci levels and how you should use the Fibonacci tools. So let's start from the support and resistance levels. Basically, there shouldn't be, for example, the indication for you to open a trade solely. What I haven't mean on by that is that you shouldn't open a trade whenever a price goes into some support and resistance. And this is merely an indication that over this level you should look for buy or sell opportunities and for additional confirmation. So first thing, where you should mark them, you should look for the support and resistance levels from 1H time frame and above. So what I have in mean, like the locals from 50 minutes time frame and 5 minutes time frame are basically useless, garbage. They are not support and resistance. Basically, it's more often they are broken than the levels from higher time frames. And because of what? Because of the support and resistance are the levels where, for example, bigger players, bigger hedge funds, trading companies are seeking for greater value. So if the price is on a major resistance, most often it will indicate for a bigger player that over here the price is, for example, too expensive. What I have on mean, if we have such a level over here, this is for our time frame GBP USD chart, and in this situation, in this zone, for example, big players think that the price over here is too expensive for them in order to buy. And in the opposite direction, when the price is trading lower, like it did over here, for example, objects, shapes, rectangle, and when the price is in such situations, in these moments, they tend to think that the price is relatively good, is cheap, and it's worth noticing maybe some kind of trade and buy the asset. So as you can see, we could draw something like this, and you will see what I have on mean, right? The prices was bouncing up and down from such levels. And it is more often why you should choose to look for the resistance and support on higher levels, because they are most often respected by the trading participants. So this is a daily time frame, so you can see what I have on mean. And what I can add to that, how you can mark those resistance and support levels, the zones or just lines, because most often they are we set them that they are visible on all time frames. And the trick to do that is to, for example, set a particular color to the particular time frame. So for example, if we mark support and resistance level on a higher time frame, like daily or weekly, let's choose then maybe red color, so that we will know if for example we will be getting closer to such level. It means that this is a very important level, because it is from the higher time frame. It should also touch as many crucial points as possible when we are drawing. So we could even take it a bit lower over here, so it would reach those highs from this move. So that is the first thing. Maybe let's have a 4-hour time frame at some resistance and support levels. but let's mark them with a different color. For example, H4, let's mark with the orange. So therefore you will know that this one is from dark orange. Okay. So then you will know that this particular support or resistance, depends on the situation, is from which time frame. So in such a scenario, you need to have in mind that this support and when it breaks, it becomes resistance, is stronger than those orange ones. That's the first thing that you need to know, how to mark them and where to look them, and what they should indicate for you. Basically, I was talking about also in the previous video about the chart patterns, for example, that over very strong support and resistance levels, you should look for additional confirmation. And let's check one scenario that we had on H4 time frame on GBP USD. And maybe let's delete this red zone. Where is the boundary? Okay, so what we had here, this was very strong resistance level. So therefore, in such situation, let's of course mark it. We have 2 peaks over here, even 3. It could be even from higher time frame. Okay, so let's mark it on red to have everything in order. Okay, it's red now, and now let's check what kind of scenario we had here. And yeah, we had head and shoulders chart pattern. So I don't know if it is visible for you. So we have the first shoulder, the head, and the second shoulder over here. Okay, it is a bit difficult to draw in MT5, but yeah, I hope it is visible. So yeah, I guess it is visible. So you can see over here, but now let's mark it with orange because it is on H4 time frame. So as you can see, clearly head and shoulders, what we do, of course, we enter at the breaking of the neckline. And yeah, our stop loss above, etc., etc. You know what, if you watch the video, then you know what to do. If you didn't, then please check the videos about the chart patterns. There are 2 parts. Basically, I covered 14 of them, of the major chart patterns. So be sure to check that video. And yeah, this is basically how you should use the support and resistance levels, how to mark them. Okay, right now we will talk about the Fibonacci tools, and I will not bore you with the explanation. Leonardo Fibonacci was a mathematician, and basically he discovered, we can say, a sequence of numbers that are very broadly used in trading and in measuring of the waves and retracement. So basically, this tool is called the Fibonacci retracement, the first one that I will cover right now. And in MT5, you have it over here on the upper side on the toolbar, or in MetaTrader 4, you can go on Insert tab, Objects, Fibonacci, and it is here, Fibonacci retracement. So as I said, we are measuring waves and retracement, and this one particular is to measure the retracement. So to know what kind of retracement we have, we are measuring the previous wave. So let's let's delete that, and let's measure this wave right here to have a better visual for the topic. So we are measuring from the notch to the notch. This is a geometry of the markets, and it is very important, and the precision is very important. So we have here, and you see the numbers are from 0, 23.6, 38.2, 50, 61.8, etc., etc. And the Fibonacci sequence is basically it says that two previous numbers, the next number is the sum of two previous numbers. So if we have, for example, 23.6 and 38.2 equals 61.8. It's not visible over here, but oh, you have it here, 61.8. And 50, as you probably guess, it is not a Fibonacci number, but it is a 50% of the retracement, so it is included in the tool because it is also an important number. And as you can see, also the 78.6 and 88.6, they are also not the Fibonacci numbers from the Fibonacci sequence, but they are included in this tool, of course, because most often those levels are used, and yeah, they just work. So basically that is all you need to know, that they are very broadly used, and they are simply working. The price most often bounce from those levels, and those levels are very good entry points, but we will talk about them a bit later. First, we will start from now you know what is the Fibonacci, you know what are the numbers, you know that 50 is not a Fibonacci number, but it is just the 50% of the retracement, and the retracement, the correction for 50% of the previous move. And yeah, you know that those numbers are also not included. Basically, what you need to do is, if you want to have those numbers, you need to manually edit the tool. You need to go to properties, you right click, you need to firstly double click on the tool, go to properties, you will have this window, you go to levels, and then you go just add, you write the number, and basically that's it. Then it will be visible on the chart. Okay, so first most important numbers are 50 and 61.8. Basically those most often are levels where you should look for take profits. If we have situation like here, when there is of course the resistance from a higher time frame, we have the two top chart pattern, and in this scenario we could enter over here, right? Let's paste some object, but let's make it a little bit more visible. Let's make it tomato color. Okay, so that would be our entry level, right? So the place when we could look for the exit level is the 50% and the 61.8%, for example. And because as you most often see, the price reacts very heavily on those levels, and yeah, sometimes the price turns around, and therefore that is why it is a very important level and a good indication for the take profit in such situations. So this is just an example. Another very important level is 161.8. When the price reaches this level, this is most often when we have some news and some very important market data releases, when the volatility is very high, for example NFPs, and the price is bouncing very heavily up and down. Most often, if it is crashing to the upside or to the downside, it depends on the situation. Most often these levels are respected. Okay, right now let's talk about the other tool, that is a Fibonacci expansion tool or measurement FE100. It also is called the AB equals CD pattern, etc., etc. It has many names and many different approaches, but the goal is the same and the core of the situation is the same. So basically it occurs on a straight correction. And what is a straight correction, we will talk about right now. So basically there are most often there are 4 types of corrections, but right now let's talk about this straight correction when it occurs. So basically we can have the straight correction in uptrend or downtrend, and it is a simple move. It looks like this. Right? When we have a clear uptrend and the first correction wave, the continuation, and the next correction wave. And the goal is, and the key is, that the first wave, the AB wave, is equal to the CD wave, and our entry level is over here. This is the indication for the moment where the trend will resume, right? So let's delete all this and see an example. Okay, so we have a situation like this. We have upward movement, and now we are using the tool to determine the entry. So we have objects, Fibonacci expansion. Again, oh, sorry, not here. It will be, maybe let's start with the beginning. Okay, we are measuring the correction. So again, let's objects, Fibonacci expansion, and we are going from here. Okay, so basically we are measuring from the first high, the first correction wave, and we are plotting the third point in the third high. This is a 1-to-1 also pattern, AB equals CD, etc., etc. You can see it is almost perfect. Couple pips was lacking to fill the formation, but you get the point. And yeah, I hope you understand what is it about. So you can see that from this moment we should have the continuation, and in such situation it occurred. But the key is how to determine where to use it. So we need to have a straight correction, which is the AB equals CD pattern and stuff like that, etc., etc. So we are using the measurement FE100. So we are not trying to catch this move, not trying to catch this move, but we are trying to catch bigger move from here. When the formation is completed, then it shows us the moment where we could enter the market. So we will of course talk about more of the technical analysis in future videos. This was just a mere introduction to the support and resistance levels and the Fibonacci. Also, we just lick the topic, we can say. And yeah, so be sure to subscribe to the channel, and yeah, wait for the next video. We are posting on this channel 4 times a week, so there are plenty videos, educational videos, tutorial analysis. So yeah, be sure to subscribe and just follow for more. That's it for this video. I hope you create an interest for the geometry of the markets and the technical analysis. So yeah, that was the goal for this video, and yeah, I hope we will see you in the next one. Take care, guys. Bye.